Hello and welcome to a fresh new edition of Value Investing Decoded. With me now is a very respected voice in the mutual fund industry. He's known for stock picking. He's known for picking them at a stage when they are growing and then holding on to them till we see maturity coming in. Personally, I know that he's very, very passionate still about knowing about different companies, trying to identify value and creating wealth. Sunil Singhania, CIO at Reliance Mutual Fund. So just for our viewers, who is a very small investor, trying to learn, trying to do some research of his own, or maybe doing some research of his own, what would you call as the mantra of investing? How would you look at investing for him? What should be the steps going ahead?
See, frankly, I believe in cash flows predominantly. So obviously, most of my focus is always on cash flows. However, at the same time, there are new sectors which might not have the cash flow. So when I say cash flow, it has to be either existing cash flows or at least pursuable cash flows going forward. So I think that becomes the key. But obviously, for a budding investor, there are a lot of other things which the investor has to look at. The simplest is obviously PE, but PE might not be the only indicator. However, it's a good beginning. And as you move forward, I think balance sheet, at least for me, becomes very, very crucial. Knowing at least the basics of accounting and therefore deciphering the balance sheet, and then going forward to the business model, to the size of opportunity as far as the sector is concerned, and then again going forward on the qualitative aspects of management and minority interest and so on and so forth. So I think this would be some of the basic steps which any investor should sort of follow.
Right. So say when you started your career about 15 years back, things were looking very rosy. You felt that it is very easy. We can just go and do what our investors may be feeling right now. But it is actually very difficult. You can lose more than 80-90% of your capital.
In fact, things were very difficult out there. In fact, till 2003, nothing was happening in the Indian equity markets except the IT sector in between from 98, 99 to maybe 2001. So it was tough. Economy was not doing well. Companies were doing worse. So, one, the profitability was obviously falling. And second, because there was liberalization, so the old business models of so many bricks and mortars companies just went for a toss. And on the other hand, you had companies trading at 3, 4, 5p. So it was not all that great, but yes, it was a good sort of a period where you could peacefully research and you had all the time to buy stocks, which is not the luxury you have today. Stocks just run up.
Right. So let's just imagine you are in your office room and you have 500 companies, various other reports, research coming in. You can't obviously buy all of them. How do you, classify them? How do you go ahead? What's the checklist that you would do before you would go ahead and dig further into a company?
See, we all have made mistakes and we keep on continuing mistakes. So one good thing is that with experience, you know that out of these 500 companies, what are the companies you don't want to have? So that reduces the list quite significantly. So I think that's an advantage of having experience of so many years in the market. And then obviously, as a mutual fund investor, you would like to diversify a portfolio. You would like to balance value with some, option value or some even in growth trajectory. So I think you'll have to, departmentalize or compartmentalize the zero down on stocks. And then obviously, as far as small cap and mid cap is concerned, meeting the company, trying to figure out the competency, the quality of their manufacturing, or the facilities. I think all these become very, very important. So numbers is one part of it, As I said, cash flows, return on capital are the key factors, and then you sort of start building upon it.
Right. So, is there any way for our viewers to, look at the balance sheet, try and identify that, what's happening in maybe a dividend payout ratio, the tax that they are paying, anything of this sort, maybe a sudden capital allocation to a sector which they may not be familiar with. All of these, may be indications which may tell you that things are not that great.
See, Pankaj, the good thing about accounting is that every debit has to have a credit. So, if there's a profit, which is a credit entry, you have to basically see where the debit entry is. So in a growing company, maybe, the debit entry would be increase in fixed assets. So I think then again, it becomes easier, whether you can digest the kind of gross block addition which a company has made. I think that is one checklist. The other thing is that, if the profit is there, then it has to finally translate into cash flows. So a lot of places we have seen that there's a profit, but it gets locked into inventory, sundry debtors, and so on and so forth. And I think we have been, saved a lot by just having a couple of these kind of checklists. And the third, which a lot of companies who have not been very fair in their practices do, is match the profit with an acquisition abroad. So I'm not saying that all acquisitions are bad, but specifically when the acquired company is an unknown entity, you don't know what is going to happen, not happen. I think we have seen a lot of these kind of things happening. So I think these are some checklists as far as profit numbers is concerned. You rightly mentioned tax, but we have also seen instances of company providing for tax but not paying for it. And I think that is again where the cash flow comes into picture. So cash flow is one document which, if it is fair, I mean, it's not fabricated, then it would give you a lot of, maybe 90% of the picture of the company's health would be in the cash flow.
Right. Can you just give an example of, you're well known to own DV's Lab, you're well known to own a lot of companies that make cash flow. So one thing is you identified them. Second thing is you held on to them. Was that because of continuous cash flow generation, they become cash flow machines?
So one is steady growth. So I think that basically will, prevent you from selling the company. Why would you sell some company which is consistently growing at 15, 18, 20%? And second is, what are they doing with cash flows? So if their payout, as you said, earlier, keeps on rising, then you know that the cash flow is healthy, the business has become a cash generating machine. And so many of these consumer companies, pharma companies have started becoming that. And you have seen how the re-rating of the P multiples happen in these kind of companies.
Right. A lot of investors also look at, dilution. I have read through, some of your articles earlier where you said that you would not want to invest into companies which are diluting. Why is that so? Can you just explain in basic detail that why dilution may not be good?
So if a company is making, say, 18% ROE, then there's no reason for the company to dilute, frankly. So I think the only sector where dilution helps predominantly, and there would be exception in other sectors, is the financial services sector. Because for them, capital is the raw material for growth. And we have seen if financial services or banks dilute at upwards of their book value, significantly upwards of the book value, it adds value, because they're able to generate maybe 15, 16, 17% return on that capital, and it continuously keeps on becoming a compounding machine. But other companies, unless there is a clear objective of the dilution, which is going to incrementally lead to the business becoming better or profits growing, I think dilution is dilution. The word itself is dilution. So you as a shareholder are getting diluted as far as your percentage holding of the company is concerned. So I think dilution, unless it is very, very justified, becomes some sort of a value destroyer for the investors.
So the mantra is that best of the company's growth would be funded by internal accruals.
Yeah, that would be the most value accretive. However, as I said, there would be exceptions. Some company might need dilution to survive. So the company might be good, the business might be good. There is some near-term issue which requires dilution. I think that might be an exception. Or there might be a company where there's a big opportunity, and to capture that opportunity, maybe they will need to dilute. So there would be exceptions, but by and large, I think companies which don't dilute have created the maximum value, and we can see that going in the past.
Right. You handle the small cap fund and the growth fund. So, again, growth will come in when you identify at early stage. Or in the small cap fund, you would identify ideas for tomorrow. Say if you're meeting a new company or a new sector, what is the first thing that you would look at? Is opportunity going ahead? How will peers come? What should be your thought process when you're looking at a very small company or small sector, which you don't know right now about?
So the one thing is that, India is behind the world by maybe 15, 20 years. The bridge is, narrowing, but still we are behind the world. So it becomes easier. So what has happened in the world is ultimately going to happen in India. So whether it's IT, whether it is telecom, whether it is real estate, whether it is hospital, niche financial services, and so on and so forth. So that if some sectors, say for example e-commerce, if Amazon has done well in US, ultimately some e-commerce company is going to do well in India. Obviously the question would be which one, but you at least have some hint to it. And then basically you dig deeper. I'm just talking about the sunrise sectors. And you try and dig deeper, and basically, in upcoming sectors, the best policy is to be with the leader. There might be others who might come up, but the best policy is to be the leader because they will survive. In some of the other smaller companies, again, history is very important. So what has a company done over the last 5, 6 years, if it's an existing company, existing sector? And then you look at the passion of the promoter as well as the growth opportunity of that sector. So if the sector has great opportunity but the promoter is not passionate, then it won't be captured, and vice versa. If the promoter is passionate but the sector itself doesn't have opportunity, then however passionate the promoter is, it's not going to give you multiple return. So the best combination would be great sector and a great promoter with a lot of passion, and obviously a past track record of at least being fair.
Right. So, say you're looking at a small cap sector now. Can you just give us any example in the last 10 years which you've looked, which has now become a very big sector? Pharma, I remember you all were overweight much before the street. Can you just give us an example of how that has blasted, and what sort of thought process was there 10 years back?
So again, if you look at pharma, say 2006-07, the market cap of the whole pharma sector, which including large caps, multinational pharma, Indian pharma, domestic pharma, was less than the market cap of one real estate company in India. That itself was like a starting point. And when you look at the Indian population, 1.2, 1.3 billion people, obviously the whole pharma sector, the domestic pharma sector that time was like $7-8 billion worth, where one drug of Pfizer Lipitor was more than that. So that there was a domestic opportunity and there was a global opportunity. I think recently, last 3-4 years, we have seen similar kind of characteristic in the chemical sector, specifically the specialty chemical sector. And I think some of our investments have worked there. So I think, it's a continuous sort of a process, and you have to continuously keep on, looking at it. Right now, we are looking at, the niche financials, which obviously have done well last 3, 4, 5 months, but still there's a long way to go. So, if you see India is a country of huge savings. Savings are now moving from physical assets to financial assets. We have seen globally how, asset management companies, how life insurance companies, how wealth management companies have really, really grown to massive sizes. In India, they have also grown, but it's still minuscule of what the potential is. So this is a great sector to be in, So I think some of these are sort of top-down, sort of analysis with a blue sky kind of a scenario of how big they can get.
And these are very basic sort of analysis, at least to start with, to know any sector. So a retail investor would also be comfortable doing it once he is aware about such analysis.
Yeah, 100%. And for a retail investor, I think the easiest thing to do is to look at them on a daily basis. Look at their own habits and how they are changing, and that would be the biggest indicator of picking up stocks. So if you start ordering on every day Amazon and Flipkart, that this is going to be the case. Or if you started ordering pizza 5 years back, that the habits are changing. Or if you have started wearing good, you are looking at brands, you are looking at good shoes, you are looking at good paint, good building materials. That the spending habit of the individuals are changing. So this itself can be good starting points.